Welcome to the Limitless Retirement Podcast. My name is Danny Gudorf, the owner of Gudorf Financial Group. Whether retirement is on your horizon or you've already made the leap, this podcast tackles your most important questions in retirement.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated.
So let's go ahead and get started with today's show. The One Big Beautiful Bill just changed everything about charitable giving in retirement. And if you're over 50, these changes could save you thousands in taxes or cost you big time if you don't act fast. I'm Danny Gudorf from Gudorf Financial Group, and today we're breaking down exactly what these new rules mean for your retirement plan and your wallet. Let's start with the biggest change that affects most retirees. Beginning in 2026, there will be a new above-the-line deduction for people who don't itemize their taxes. If you're married and file jointly, you can deduct up to $2,000 in cash donations. And if you're single, up to $1,000, even if you take the standard deduction. This is huge because most retirees haven't been able to deduct their charitable giving in recent years unless they had very large expenses to itemize. The key caveat, this applies only to cash donations to public charities. Donor-advised funds, private foundations, and non-cash gifts do not qualify. Think about it this way. Many retired couples give $2,000 or more to their church each year. Before this bill, that money provided no tax benefit. Starting in 2026, that same $2,000 donation will create a real deduction on top of the larger standard deduction and other senior benefits. That means more of your retirement income stays in your pocket instead of going to the IRS. And strategically, this deduction can create what I call a hidden Roth conversion opportunity. If you plan to convert $30,000 from your traditional IRA to a Roth, that extra $2,000 deduction means you could convert $32,000 and pay the same tax bill. That's free money working for your future. But there's also a catch for higher income retirees. Starting in 2026, the new law imposes a floor on charitable deductions when you itemize. Specifically, you must reduce your deduction by 0.5% of your adjusted gross income. So if your income is $200,000 and you donate $10,000, you can only deduct $9,000 because $1,000 is lost to the floor. The higher your income, the bigger this haircut becomes. This mainly impacts affluent households and can affect retirees who make large contributions, especially into donor-advised funds. And that's why timing is everything. If you're planning any major charitable giving, you'll want to get it done before January 1st, 2026. After that, the new floor kicks in and trims your deduction. This creates a major opportunity for strategic giving in 2025. If you normally spread your gifts over several years, consider bunching them into 2025 using a donor-advised fund. That way, you can lock in the full deduction before the haircut starts, then distribute the money to charities gradually in future years. Just don't wait until the last minute because donor-advised fund providers are likely to be swamped with requests in December. Now here's the silver lining for retirees age 70 and a half or older. Qualified charitable distributions from IRAs are completely untouched by these changes. In fact, they become even more valuable because they're not subject to the new floor, haircut, or reduction. Every dollar you send directly from your IRA to a qualified charity reduces your taxable income dollar for dollar, counts toward your required minimum distribution, and lowers future distributions you'll be forced to take. For example, say you're 72 and your required minimum distribution is $15,000 this year. Instead of taking the full distribution, paying taxes, and then writing a check to your church, you could send $5,000 directly from your IRA as a qualified charitable distribution. That leaves you with only $10,000 taxable income from the IRA while still fulfilling your charitable commitment without paying a dime in tax on the $5,000. The key is knowing how these changes fit into your overall retirement tax strategy. The new $2,000 deduction for non-itemizers helps most retirees. The new 0.5% AGI floor limits high-income donors. And qualified charitable distributions remain one of the most powerful tools for charitably inclined retirees. If you have significant assets and a desire to give, 2025 is the year to front load your contributions. Using a donor advised fund lets you capture the full deduction before the floor hits, then spread out the giving over time. But you must act before the end of 2025 to take advantage. All of this shows how retirement tax planning is constantly evolving. What worked last year may not work next year, and the next 4 years could be your best window for optimizing your retirement strategy. The rules aren't permanent, so understanding how to adapt is critical to protecting your income and your legacy. Now that you see how the One Big Beautiful Bill impacts charitable giving, you'll also want to learn about the other major tax changes it created. These new rules open up a critical 4-year planning window that retirees can't afford to waste. Click right here to find out why. Thank you for listening to another episode of the Limitless Retirement Podcast. If you want to see how Gudorf Financial Group can help you get the most out of your money, go to gudorffinancial.com/get started. This is where you can schedule a 20-minute call to see how our firm can help prepare a free retirement assessment. Please remember, nothing we discuss on this podcast is intended to serve as advice. You should always consult a financial, legal, or tax professional that is familiar with your unique circumstances before making any financial decisions. Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, a broker-dealer, member FINRA/SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and Gudorf Financial Group are not affiliated.